Okay, well, Robert Sockin is global economist at Citi. He's joining us. Robert, good to have you with us here. Thank you very much for your time. This is, I think more dovish than hawkish, right? Robert, how are you looking at it, the Fed policy and what it means for markets from here?
It's a great question, and thank you for having me. I think Chair Powell's goal today was to mostly emphasize a somewhat neutral position. The hike that we had today of 25 basis points, widely expected by analysts and by markets. And the key was, well, how would they frame that hike and how would they frame the outlook going forward? And I think our expectation, the way Chair Powell played that, was that he said, look, they're data dependent from here on out. They haven't made any decision based on the current data they're seeing in front of them. And they have 2 more months of data until the next meeting to be able to judge that. So I think some people were looking for Chair Powell to signal definitively that they would pause at the next meeting. He did not do that. He left every meeting open, but said that it's going to be very data dependent. And even though they've gotten some encouraging inflation data of late, they really want to see how data evolve between now and the next meeting. So I think I would describe it as Chair Powell was mostly successful in kind of striking a neutral stance. I think it comes down to the data, and if someone were to argue with me that the Fed was done, but they had a dovish view on the data, I think that's very reasonable. We think that they're going to end up pausing in September, but there's going to be enough persistence in inflation to lead them to hike one more time in November. So I would describe the meeting as largely as expected and mostly kind of a neutral stance out of Powell.
So what does this mean for asset classes like equities, Robert? I know you do track the economy widely, but on the equities front, do you think that the markets globally, as well as a market like India, could continue to move higher as we perhaps get to the start of what could be a rate cutting cycle at some point over the course of the next 12 to 18 months?
I think this has the potential to be very positive for risk sentiment and very positive for U.S. asset markets and global markets, depending on how the data evolve from here. We recently put out our global outlook last week, and a lot of the themes that we're seeing in the U.S. we're also seeing globally, which is global growth and U.S. growth are proving more resilient than expected. Most of that's coming from the services-based economies and services sectors. But at the same time that growth is resilient, you are starting to see this disinflation narrative. Goods inflation's come down significantly, food and energy's come down significantly. And now it becomes a question of, are we going to get that disinflation in services? And we've had some good data in the US, as Powell noted. We've also had some good data globally for services inflation. Now it's still running too high. But I think we're at a point, not just for the Fed, but for many other central banks as well, maybe we're getting to the point where they don't have to do more. And, the probability of softer landing scenarios have gone up, and maybe they can start cutting rates sooner than we expect. Our base case is still that the Fed does more, the ECB does more, the Bank of England does more, and they're going to hold those policy rates at high levels until the middle of next year. So we still think that there's a lot of space for people to reprice what central banks are going to do, and that inflation is likely going to stay sticky going forward. But we're at a point, and Chair Powell really emphasized this, where the data could surprise us and break in a more positive direction, and that could mean looser policy sooner than expected. And that would be very positive for the stock market, not just in the U.S. but globally.
All right. Hi, morning, Robert. If I got that correct, you're factoring in higher for longer. So how many more rate hikes do you think the US Fed could deliver? And also, what do you make of the commentary on recession? From mild recession, now they seem to be pushing that. There's a change of stance out there as well. So comments on both these two.
Yeah, it's a great question. So yes, exactly. We're higher for longer. We still think one more out of the Fed that they deliver in November. I would say, and this is true, this is my view of the Fed, but also other major DM central banks, that whether they're done here, after, let's say, the most recent round of hikes, even if they don't do any more from here, I still think the bar for cutting is very high. And so even if we're at the Fed's terminal rate, I think we're still in a higher for longer world where the bar for cuts is high and they hold those high policy rates for an extended period. In terms of recession, it's really quite striking. We've been shifting out our call for a U.S. recession over the last several months. Originally, we thought it would start in Q3. A few months ago, we shifted it to Q4. And this month, in our most recent outlook, we shifted it to Q1 of next year. And you can also tell that story for a lot of other economies around the world. We thought that the UK would be softer than it is right now. We think that recession got pushed out. And a variety of economies, Canada, Mexico. And so, we are seeing more resilient data. Our view is still, if you look at the U.S. and some other major economies, you're going to have to see a significant loosening in labor markets in order to break this very high services inflation that we've seen. So even though we've been shifting out the calls for recession and the calls for low growth, we're still holding on to that because we think that's what's necessary to crack inflation. But as I said, some of the services inflation data has been looking better of late, and maybe you could get services inflation come down much lower without a significant loosening in labor markets, a significant slowdown in growth. Historically, that would be very unusual, but this cycle has been full of surprises. So, maybe we'll have some more going forward.
So just one final question, since we're talking about growth, where do you see India's growth trajectory from here on? I mean, IMF recently raised their India growth forecast to about 6.1% on GDP, and now they expect it to be the fastest growing economy, in 2023. Would you concur with that view? And what would the comparison be with China?
Yeah, no, it's a great question. Actually, I was going to bring up China in that question before you mentioned it. We have a very positive outlook on India as well, consistent with the IMF. We think it's in a strong growth position. Actually, if you look around the world last year, the best performing economies were in Asia, and that still holds true in our forecast this year. You're seeing a lot of economies, India, but other economies throughout Asia have performed much better in this cycle, have not had as extreme of inflation pressures, have not had to tighten as much, and growth has held up relatively well. So we're pretty positive on India. And I think it's an interesting comparison, as you said, to China, because China has been going in the other direction in our forecast. So we, a few months ago, had China growing at over 6% this year. We marked it down to 5.5 a few months ago, and in this forecast round this month marked it down to 5. So China's been going the other direction, while India, I think, has been having stronger prospects. I think for China, 5% is probably the floor growth rate for this year, because we think you're going to get a range of stimulus measures to come out of the government in coming weeks and months. And if growth is running even weaker than 5%, we think they'll just ratchet up the stimulus. But China is certainly in a much weaker position right now than India, and has a lot of other structural issues to deal with, such as turning demographics, difficulties within the property sector. So,
Right.
I think over the next decade, this is going to be one of the key questions. How does India grow relative to China as the other major large emerging market?
Sure.
And I think when I look at the potential growth rates of the economy, I would say the prospects are much stronger for India in the near term than they are for China.
All right, we'll leave it at that. Robert, thanks a lot for joining in and speaking to CNBC TV18. Let's slip into a quick break. On the other side of the break, we have plenty of stocks to talk about. Our entire list of top 10 stocks coming up in a bit.